Hello, everyone. Thank you very much for joining us for this lunchtime webinar. For anyone listening back on video, this is the Thursday, the 23rd of March. My name is Nick Charlambus, and I'm the Managing Director of Alpha Wealth. This is a series of webinars that we've been doing over the last number of months. This one particularly is focused around helping you as an individual manage your own finances and giving you some really useful tips in order to be as financially successful as you can be. I'm joined today by several of my colleagues, Clean O'Donoghue, who's Director of Business Development, and also Keenan Cunningham, who's Head of our Marketing Department. And I'm going to spend the next 25 minutes or so just going through a few areas of personal finance, as I mentioned. My colleague Keenan is going to put into the chat some useful links, so if you look out for those, and I would encourage you all to answer as many questions as you can. Please do so through the Q&A function, and my colleague Cleaner will be manning that. But we really want to make this as, I suppose, interactive and as useful as possible. Just for those of you that are not familiar with Alpha Wealth, we're an independent financial services provider with offices in Cork and Dublin, and we have currently 9 individuals, 8 of which are on the advisory side, providing independent guidance and advice to all types of individuals, regardless of what part and I suppose stage of your financial life cycle you're on. You can see here from the screen that we have over 60 years combined experience between us. We have over 100 million of assets under management and 3,000 plus clients. And if anyone would like to get any accommodations, please do look us up on Trustpilot. Getting into the crux of today, guys, I want to talk about financial independence. This is really about helping people understand, making sure that you have a goal and helping you to get to a point where you don't have to physically work and certainly not work to the same capacity. I'm going to go into a little bit more detail about that, what it looks like for you, how you can achieve it, and achieving other objectives as well. So really, the main focus is, and I'm 49 years of age myself. We have people at different stages that I speak to. I spoke to someone who was 60 early on today, who actually has just about reached that point where I describe financial independence as being at a point where you have enough money to not have to work or work at the same capacity. And what I mean by that is that you may choose to. We're talking now about, I suppose, phased retirement, where people are starting to sort of like take either lesser hours or change jobs or indeed change industries. And I suppose it helps certainly from a mental health perspective rather than this kind of hard finish. And the main key thing is, guys, making sure that you've paid off all debt, you've covered all future expenses, and you have an income stream that's a passive income that covers all of your expenses. So
Nick, on this, sorry, can I just interrupt you? So many people who have retired own their own home and have a really good pension. But is this becoming more difficult for the younger generation and for those that are following?
Yeah, no, it's a good question. And I suppose potentially yes is the answer. We're finding, obviously, recent months, interest rates have gone up significantly. So over the last 13 or so years, we've been in this really unusual environment of next to zero interest rates, which has really helped people who have mortgages. And now we're finding, obviously, the cost of living has increased, not only just because of the rate increase in interest rates, but also obviously, cost of energy and so on going up. And it's making it more challenging for people, especially if you are trying to save towards your retirement and indeed funding various different things you have. Anyone who's looking to buy a property, of course, or indeed trying to build, we've seen the cost go up significantly, and therefore it's eating into this kind of reserve, as I call it. The point, I suppose, of today is that don't compare yourself to others. Really it's about where you are and how you can maximize your own financial position. I moved to Ireland back in 2000, and I've been here for obviously 23 years now. I've been in stages where I've been unemployed. I've worked for companies. I set up my own company 9 years ago. I moved countries, of course. I'm from the UK originally. And the key thing is understanding about what is important to you. My colleague Keenan has put up a poll, and I see some of you are answering the questions now. What we're trying to do is just try and find out, I suppose, what is important to you? Is it to buy a property? Is it to help your kids through third level education? Is it to plan for retirement, pay down debt, and so on? And it could be a combination of these things. And the most important thing that we do as financial planners is help our clients reduce their costs, but also find the right balance between where they're allocating their excess funds. And the starting point for that really is what I call a financial budgeter. It's a really useful tool. My colleague Keenan's going to put it up into the chat function. It's available completely free on our website. And I would encourage all of you, if you haven't done one already this year, the first thing you should really do if you're looking to try and benefit yourself is to complete this. It should only take you about 10 or 15 minutes. I would generally recommend that you do it with your banking app open or a month's worth of bank statements. And the main purpose of doing this is not only to focus your mind on what you're spending your money on. I would suggest that you do use a financial planner to help you understand about how to reduce some of the costs that you have. These include things like insurances that we generally find that we overpay for, and that covers a whole myriad of different things, from health insurance to mortgage protection insurance, car, house insurance, and so on. And also then finding what the difference of what you earn and what you spend is. This example is of someone who, in a dual income scenario, is earning about 6,500 a year net, a month, sorry, net, and then their monthly expenses are around 5,300. Again, the point being, it's all about the relative. How much of a cash balance do they have? Does it actually equate in reality? Because a lot of us feel that we should have excess every month, but we don't see it. And this is where we can help you understand about where that money is basically going, and then to allocate that money to different types of vehicles that will help you achieve your financial objectives. I'm just going to talk briefly about my own financial roadmap, as I call it. And this is important to all of us. And again, this is something that we help our clients with. You can probably see here on the screen, for my own details, I'm 49 years of age. I've put, now we call it a pension illustration. It's not just around pensions. It could be based on a combination of pensions and rental income. It could be, you know, different sources of incomes that you may have, including pensions from different jurisdictions. I'm doing a talk next Tuesday, the 28th. For anyone who's worked in the UK for 3 years or more, I would strongly encourage you to look at buying back state pension years. It's a fraction of the cost for what you'll get, and it's a really useful thing to understand. And if you don't avail of that in the next 2 months, you'll lose an opportunity to buy back 11 years that basically are going to go to waste. With regards to myself, I've set my kind of, I suppose, financial independence age at 63. The reason being is that I have 4 children in a blended family, the youngest of which is 8. And I've kind of set myself a goal that by 63, I'd like to get to that position. So how am I looking to achieve that? Well, as you might see here on the illustrations, my projected fund to 63 is 770,000. which in today's money, allowing for inflation, an average rate of 3% a year over the next 14 years, will bring that figure down in today's terms to about 500 odd thousand, which for me, based on my circumstances, and obviously I'd be relevant to both the UK pension and the Irish state pension, I believe will be sufficient. And just to put it very simply, if I was to draw that money down at 63, a figure of 500,000 in today's money, that would give me approximately a quarter tax-free, which is about 127,000 euros, and then an income of about 30,000 a year. And that for me would be sufficient for the lifestyle that I would like to lead at that time. In order for me to get there, what it's showing you here is that with a pension fund of 220,000 that I currently have, that it would require a contribution of about 1,000 a month. My company's paying about 10% of my salary into that, and then I'm funding the balance, which is 14%. But the key thing is that the government are giving me a 40% tax rebate, which is costing me 350 euros a month. So basically, for a cost of 350 a month, I'm going to be able to be financially successful at 63.
Can you give us an idea of how much people would need to retire comfortably?
So this is a question that's specific to individuals. Obviously, I've shown you what looks like for me. However, if you're in a situation where you have two people who are working, it can be based on the cumulative between them. Or if there's a scenario where somebody wants to retire early in their 50s, which is something that we help our clients with, you may need to build a bigger fund because obviously you've got a longer duration to draw that money down from. And this is where we do this kind of cash flow modeling for our clients. It's a really useful process. It's very simplistic. There's no drama in order to do this. We have some really good tools to help clients understand. And more importantly is that you have to review it once a year because things change. We've seen over the last few years a whole myriad of things that have happened between COVID, rising interest rates, the Ukraine crisis, rise in energy costs. But the point being is that you have to just make sure that you find that right balance and in terms of managing the different types of things. But generally speaking, as a rule of thumb, anybody that retires on a fund of 500,000 in today's money, I feel should have a sufficient income to be able to finance themselves successfully. Okay, I'm just going to move on there, and please do ask any questions on the Q&A. I do want to make sure that we are addressing any needs that people have, and I do appreciate you filling in the poll. I can see there that there's a lot of you that are looking at, I suppose, buying a property, and we help our clients in terms of financing that in the most effective fashion possible. My colleague Keenan has just put up the second poll, and this is where it comes down to understanding what you have. So the first thing we do when we talk to clients is to engage with them and say, okay, give us some information about your pension fund. And if you don't know, let us help you understand that. We get that information directly from the pension company and report back to you and say, okay, this is the value of your pension fund, and this is where your funds are invested. And I can see there that, asking the question about, do you know what your pension is and where the funds are invested? There seems that quite a few people are not quite sure about both aspects. And I think both are equally important. Approximately 40% of you don't know the answer to those. I think this is really, really important, guys. If you had 10,000 euros somewhere in the universe, I personally would like to know, well, okay, what is it invested in? What is it actually doing for me? And more importantly is what the costs associated with that. Because if the costs are very high, you could find out that 10,000 could be worth nothing over the next number of years. In relation to, I suppose, pensions and the opportunity for all of you, and the chart on the screen there, you can see that there's very generous limits to what you can put into your pension scheme. I referenced earlier about what my contributions are, costing me 350 euros a month. But if you're playing catch up, or if you happen to have excess funds, or if you happen to get a bonus, revenue will allow you, depending on your age, to put fairly considerable limits into your pension scheme. So again, in my case, 49 years of age, I can put 25% of my earnings, 50,000 a year, which is 10,000 euros each year into my pension fund, and I get 40% tax-free from that contribution. The key thing with pensions, guys, is that it grows tax-free, and people often ask me, well, why should I put more money into my pension? Why should I make this additional contribution? And I suppose the point I'd make to you is that it's going to buy years of your working life, and you make hay while you can. So if you can afford to do it, absolutely makes sense.
Can I ask you a question there, Nick, that's come in? It's given that pension investment may not give away a good return and may depreciate in value over time. What is the value addition for additional pension contribution over investing maybe in the market, so in shares, property, or even gold?
I suppose I would disagree with that comment respectfully, that pension funds over 5, 10, 15 years have generally always outperformed other asset classes. And the key thing to understand again with pensions is that they grow tax-free. So anyone who thinks that by having money personally and that they invest that are better off than putting it into a pension fund, I would strongly disagree with that. Not only do you get this 40% rebate from government, but you also get the growth of your pension fund tax-free. But the key thing is you can mimic what you want to do personally in your pension fund. You can buy funds in gold, you can buy funds in cryptocurrencies, even if you're so inclined. You can invest in property in your pension fund. So there's loads of different opportunities to invest in different asset classes. And this is where it's important to get guidance and advice. But it's not true to say that all pension funds have fallen. Last year, we advised our clients in funds that made money. A lot of funds would have lost, obviously, because of a lot of the issues that we saw globally, but it isn't always true. But over a period of 3, 5+ years, these funds will always generally. The reason why people might see negative growth is because of fees and charges. And this is what we would suggest that you would be very acutely aware of. Okay, I'm just going to talk about how we help our clients compartmentalize their money. I mentioned earlier about doing that financial budgeter. Short, medium, long term. And I want to really express this to you. If you have any financial objectives that are less than 3 years, if anyone that answered the question about what was important to them and said buying a property, if that occurs within the next 3 years, your only course of action is to put your money into a bank, post office or credit union, knowing that you're going to earn next to nothing, but that you have a proper savings plan in place, that you commit to a certain amount and try and stick to that. However, if your objective was 3 years and beyond, so for example, let's say you want to buy a property in 5 years' time, there are other options available. And we have already covered off on the long-term aspect, which I would primarily describe as pension investments.
So given interest rates are rising, Nick, am I better off to keep money in the bank on deposit so that I can benefit from rising deposit rates?
No, in short, and again, I want you to focus on the chart on the screen here. If it's less than 3 years, yes. If it's more than 3 years, no. We haven't seen much of an increase in deposit rates. The best deposit rate out there at the moment is with PTSB at about 1%, and you lose 33% of that to dirt. So you're not going to make more than 2/3 of 1%. It's not worth your while, and deposit rates won't go up like interest rates have. The banks don't need your money because of the fact that KBC and Ulster left the market. They typically don't require people's deposit money, so they won't pay you according interest rates. We have an account, and I did say this wasn't going to be a sales, I suppose, webinar, but one of the things that we help our clients with is not only understand about the opportunity, but we try and give them the best tools. And this is an example of a savings account that we use. It's called the Alpha Savings, and we set up a club where it offers people the ability to put a minimum of €100 a month into something. We help you understand about what you're trying to, I suppose, plan for. I did a previous webinar about how to save 30,000 over 4 years, and I showed examples of how we can help you achieve that. But the most important thing is that you try and keep pace with inflation. And I think that's what the earlier question would have alluded to, that there is no point you leaving money in the bank earning 0, 1% a year, where inflation is running at 3, 4, 5% a year. It means that you're guaranteeing yourself to lose money. We would look at options. We have a plan through Zurich. As an independent broker, it's the savings plan that we most favor. And you can see there the growth that we've experienced over the last number of years. Now you'll see, obviously, in 2021, this pullback that we've witnessed, but over a medium to longer term, these accounts have annualized 5% per annum. And if you look at more recent times, the fund is up year to date. And ironically, despite the news last week about Credit Suisse and First Republic, these accounts actually improved in value. And this is where we help you understand about what the best types of savings plans are out there. We are offering any people that do this savings account through us up to the end of April, €100 back, where we will physically pay that to you by setting up this account, and we've set the premium at €300 a month or more. There's no catch, there's no, I suppose, T's and C's, apart from paying that premium for at least 3 months. Just going to move on briefly, guys. And again, this is to give you kind of a quick sense about things I think that you can do. And I know a lot of people are giving out about mortgage rate rises, but I asked the question about, are you doing the best you can? If you have a mortgage, there is an opportunity if you do something, which I'll talk about in a second. But even things like mortgage protection, anyone that has bought a property and borrowed money from the bank, you have been forced to take out mortgage protection cover. And I come across clients all the time that are paying €50, €100 a month because the bank advisor told them that they have to take serious illness with it, or that they needed additional cover. And I'm not really hugely in favor of people doing that. I think that you should protect for a specific need and decide separately whether you need anything additionally, and then that becomes your plan that you have more flexibility with. The same for things like house insurance, car insurance, and so on. We help our clients get the best rates. We broker that. These are not products that we sell, but I'm guaranteeing you that we can save you money in those areas. Loans, obviously, there are those people that have car loans, credit cards, and so on. And I help clients manage those. I help them understand about reducing the debt and also the cost of debt, and making sure that you're getting the best interest rates that you can. And particularly for credit cards, moving the credit card debt to avail of zero interest accounts for a period that gives you a little bit of breathing space. So my colleague Keenan is just going to put up the last poll, which is basically just inquiring around whether you have a mortgage and what type of mortgage you have. And this is a very simple example about how we feel that you can save money. So I've had a tracker mortgage in the past. I've had a fixed rate mortgage and a variable rate. And for anyone that has a tracker rate mortgage, there is an opportunity for you still to review with your current bank. And again, there's no drama with this, to find out what the cost of fixing for, say, 5 years would be. And in some instances, it makes a lot of sense, depending on what your situation is with the property and whether you're likely to stay there for the foreseeable future. Same with those of you that have fixed rate mortgages that come into expiry in the next year or two. I'd strongly encourage you to talk to your bank immediately, and I'm talking about this week, to ask what is the cost of refixing now. You'll find in a lot of cases there's no cost to refix, and it would make a lot of sense for you to do that rather than waiting for the fixed term expiry to come in 6 or 12 months and then be hit with a much higher rate than you would face today. Anybody that's on a variable rate, I can't but encourage you to fix it immediately. It makes zero sense to stay on a variable rate mortgage in this climate. I can see there are more questions coming in, and obviously we will address those, so please do keep asking them. I'm doing a webinar next Wednesday, the 29th of March, and for anyone that's listened to this on video and it's that date has passed, these webinars are available on our website to access with no cost. And this is one that I am very, very, I suppose, interested in, particularly for clients who are paying tax at a high rate. Generally speaking, if you're earning over 40,000 a year or more. I've spoken for anyone who's been on these webinars previously about this scheme. It's called the Employment Investment Incentive Scheme. And I just want to leave you with one quick scenario about if you had money in the bank, and let's say you didn't need access to it for 4 to 5 years. You can make an investment of, say, 5 or 10,000 euros. I'm using an example of 10,000 here for ease of illustration, where the Irish government will give you a guaranteed 40% back on that investment. And at the end of the 4 to 5 year term, you expect your 10,000 euros back with at least 20% profit. And obviously doing the simple math on that, you can see there that for a net cost of 6,000, you're looking to receive 12,000 back in total, which is doubling your return. I'll go through this more next Wednesday. And for anyone that does register for the webinar, if you've not already done so, and I know some of you have, I would encourage you to listen into that for half an hour. And if you can't make it, we can forward you on the video. So please do get in touch with us. But we're also offering anyone that's on that webinar next week the opportunity to win an overnight stay in the Anua Hotel Suite, which includes all of the hotels here. Unfortunately, Dublin One and Ariel House are not included as part of that. There's just a slightly different management contract that they have, but it is available for all of the other ones, and there will be someone that wins that prize on that webinar. Just before we get into the questions, guys, I just wanted to say Alpha Wealth offer a full financial review. It's an hour-long process where we go in and do that sort of deep dive and give you more information around your pension. We do the heavy lifting for you, as I said. We feel it definitely benefits our clients. We get more information for you in terms of trying to cash flow forecast for you, giving you advice around how to reduce debt, get the most out of your savings. The normal charge that we offer is 199 euros. We are discounting that by 25%. And my colleague Keenan's going to put into the chat the code to use. If anyone would like to get details of that, and typically if they want to speak to me beforehand, or indeed ask further questions around that, we do it typically either in person in our office in Cork, or indeed I'm happy to meet someone in Dublin, or indeed over Zoom or Teams if you prefer, at a time and day that suits you with a partner if it's appropriate. And I do think that you generally would benefit hugely. I am seeing some financial advisors out there, the likes of Owen McGee, charging anything from €300 up to, believe it or not, 2,500 for the same process that we offer. And I'd strongly encourage you to take advantage of that opportunity. So I'd like to pass it on to my colleague, Cliona.
Yeah, we've lots of questions, Nick, so we might jump over to the questions. So the first one is, my son is going to college in UL. He is renting there, and I believe there is a €500 introduced in the budget that he can claim towards rent. Can you give just some recommendations or advice around how that can be claimed?
Yeah, so this was a question that came into me actually earlier today, and I appreciate the question. So for anyone that's interested, and I can send you on the slides after this webinar, this is, I'm showing you on the screen, what you need to do. I would encourage all of you to have logged into your Revenue Online system. It's a really easy, user-friendly tool to use. You can set it up within minutes. And once you do that, you basically log onto your account. You can see here the page on the My Account. You click on the Manage Your Tax 2023 for this year, and basically go into the Add Tax Credits, or Add New Credits, sorry, section, which is on the screen there. And you can see there that once you go through that, the rent tax credit is listed there, and you just put in the €500 credit. You do not need to provide evidence of that. It's really straightforward. And what you do then is go back into last year. So essentially go to review your tax for 2019 to 2022 and carry out the same process. And that's €1,000 back to you. For anyone that's renting, it's money for jam. And I would strongly encourage you to do this immediately. And again, I can send you on the link, but you can just type ross.ie, and then it's fairly straightforward from there on in.
The change in pension legislation this year provides some additional advantages for PRSAs. I know it's complex and there may not be time, but what are the summary benefits to an individual and family?
So again, thank you for the question, Gus. Basically, for anyone that wants to fund their pension, and this applies to employees as well, there are no limits to how much money can be put into your pension scheme. So interestingly, to reference, in the UK, the maximum that anyone can put into their pension scheme in any given year is 60,000. It doesn't matter whether they're earning €1 million a year or more. In Ireland, believe it or not, and the product that it's available for is called a PRSA. And without getting into too much terminology, it's really just a pension scheme for all intents and purposes. You can put as much money from a company, or if your company wants to remunerate you by giving you a 50,000 salary and a 20,000 pension contribution, that can be made into that pension scheme called a PRSA, and you can fund it as aggressively as you wish, up to a cap of 2.15 million. So for example, let's say that you're involved in a business that has some cash in the business account. What a lot of business owners are doing is that they're paying into pension schemes for their directors, for their staff, for their children, and it's completely bona fide. And it's been a real, I suppose, game changer for the pension industry since the 1st of January this year.
Should you put off AVCs until after you have got on the property ladder?
It depends. Again, it goes back to what I said earlier about this balance. So really what I would suggest is that if you have your property financed, and what I mean by that is that you have lined up your 10% deposit, you have repayment capacity, and depending on when you're looking to buy this property, I would make AVC contributions. You can always stop them. So if, for example, let's say you take out a mortgage and you find that you need to pull back on your AVC, then do so. An AVC is just an extra payment to your pension. And the bank will take an allowance of that in the repayment capacity, because they know that you can stop your additional voluntary contribution or pension payment. So it's not going to count against you. But again, it depends on where you are in your life. It depends on how much of a pension scheme you're likely to have built up and how soon that property purchase may happen.
So I'm planning on buying a residential property in the next 3 years and looking to save around 30,000. Where is the best place to invest?
Again, it goes back to that rule of thumb I said, anything less than 3 years needs to be the bank. 3 years is not long enough to put it into anything else. My advice is Bank of Ireland, they have a mortgage saver account. You can put up to 2,500 a month into that account. And by putting your money in there, you can potentially benefit from 2% of reduction on the mortgage when you draw down with Bank of Ireland, if you do. And if you don't, it's just a good savings vehicle, full stop.
And just on the savings thing, and then I'll move back to the other question, regarding the Alpha Savings and Investment account, what is the minimum you can put into it per month? And is there a minimum time frame you have to leave your money there without any, I suppose, exit penalties?
The minimum amount is €100 a month. You can put in lump sums as well, also, which typically is 5,000. There is no minimum term at all. We offer it at a 0% entry cost. There's no cost to exit. But again, guys, I'd use the rule of thumb of 3 years. We've had clients withdraw earlier than that. But in order for it to make money, in order for it to become as viable as possible, given returns of say 5-6% a year, ideally you'd want to give it 3 years plus.
So my situation is we bought a 2-bed apartment back in 2006 and are now struggling as a family of 4 and trying to save, but it's hard. Have you any advice on what steps to take to progress to upgrading to a house without the risk of falling off the property ladder in the process?
So I've kind of alluded to things I think we can do. So for example, in that instance, I'd like to talk to you directly, show you how I can help you save money, depending on what you're spending your money on. For example, health insurance for anyone that has children. I would suggest strongly that you don't pay for more than one child. There are offers out there to reduce the cost of health insurance and make sure that you take advantage of online discounts. I mentioned earlier about reducing other insurance costs like mortgage protection, car and house insurance, but helping you financially plan better. And that's really where I'd like to be able to step in and be able to help you in terms of this process. Obviously, you know, it's challenging, but as I said, the key thing is that you're making the most of your situation that you're in. And typically, I think, you know, with taking advantage of tax credits, you know, have you applied for credits going back as long as 4 years, for example? I'd like to think that we can definitely help you in that instance.
So if your mortgage has moved from KBC to Bank of Ireland, can it be fixed now, or would I have to wait until some time to look for a fixed rate?
You can fix it immediately, and I'd strongly encourage you in that instance to do so.
And what about for somebody that was on a tracker with National Irish Bank and they are now moved to Pepper Finance? It seems that they won't change it to a fixed rate.
But you can move your mortgage to a different provider in that instance. Now, again, if that's something that you'd like some guidance with, we don't provide mortgages in Alpha Wealth, but we give independent mortgage guidance. And I'd like in this instance, if you'd like to just reach out to me directly, and I'll be able to guide you about your best options. And there's no fee or cost to doing that.
And I think this goes back to the same one earlier. Is it better to plan buying a house now or to put more money into AVC pension instead of buying a home? I'm 34 years of age.
Well, ideally do both. And again, this is where you need to find that balance of, have you successfully funded the purchase of the property? Do you know how much this property is going to cost you? Do you have your 10% deposit, or can you avail of government schemes like the Help to Buy scheme? And once you have that boxed off, then you can focus on the AVC. But obviously, if you're looking to buy, what I'd like to suggest is put yourself in the driving seat. And once you know that it's achievable and you have a mortgage kind of almost ready to go down, and if you're looking to buy in the next 12 months, I would absolutely engage with an independent mortgage broker and do not speak to your bank directly about this, because I don't think that that's the best thing to do. Then we can help you understanding about making additional contributions into your pension, but also that medium-term savings vehicle to help you build money up for the rainy day, for a new car, for helping your kids through college and so on.
So if you had a tracker mortgage paying 1.15 above the ECB rate and 4 years remaining on it, would you fix for the remaining 4 years
I would contact your current bank and ask them about the best rate for a 4-year fixed. And if it's better than the current tracker rate, then absolutely I would fix it. Because the tracker rate's only going to go higher.
Sorry, that's the end of the questions. Thanks, Nick.
No problem. Listen, guys, I'm conscious of time and I really appreciate all of the engagement and the questions you've asked us. Again, just to remind you about the webinar next Wednesday, the 29th, I'm going to talk a little bit more about how you can save the tax you pay, which is a way in which we can help you save money. But again, look out for us. Obviously, you can follow us on social media. Do make sure that you look up any of the webinars that may be of interest, particularly in terms of the savings one. But if anyone would like to book a financial review with us, please do get in touch. You can get me on my email address, which is on the screen there, nick@alphawealth.ie. And there are several financial advisors in Alpha Wealth, and we'd strongly encourage you to reach out and touch base. Thank you very much for your time. And I'll leave the webinar open if anyone does want to ask any further questions.